Hello and welcome to this very special show on the Economic Survey 2026, which is going to get tabled just a few minutes from now. This is ET Now and you're at the headquarters of the Budget 2026. I'm Harsaita, with me is Nayar, and over the next hour or so we'll try to dissect that survey which gets released in just another few minutes. We'll also have the FM speaking, so we'll have all of that coming in live to you. But at this point, Aditi Nayar joining us, Chief Economist at ICRA, to talk to us about what she is likely going to pencil in with regard to the economic survey. Hi, Aditi, good morning. Historic day, of course, but talk to us about what you're penciling in. What's the expectation likely looking like? Give us a quick recap before we get to looking at the fine print of what the economic survey is saying.
Thank you so much. Important day indeed. This is actually a very interesting juncture that we are at. We are projecting for next year based on the current basis that we have both for the CPI and the IIP. But actually, we are going to be moving to new base years for both of these very critical indicators in the next 1 month. So as of now, we are doing forecasts for FY27 on the existing basis, and we're looking at a real GDP growth that's probably likely to be around 6.7% in FY27, and we're penciling in a 9.8% nominal GDP growth for next year. So we'll be looking at what the ECO survey projects in this context, of course, keeping in mind that our forecasts are on the existing base, and numbers may well change, growth rates and levels could be quite different once the new figures come in at the end of February. And with the CPI as well, as of now, we're looking at the CPI doubling from 2%, which is right at the lower end of the MPC's forecast range in FY26, back to a normal sort of 4% or thereabouts in FY27. So there again, what the ECO survey indicates, any hints which are there for the fiscal trajectory, we're now moving to the debt to GDP being the nominal anchor for the fisc, moving away from the strict fiscal deficit to GDP targets. So what hints does the ECO survey give for what we can expect on Sunday in terms of the debt to GDP, the fiscal deficit to GDP, what it means for borrowings? I think the bond markets would be particularly interested in that.
Okay, so lots to watch out for. Aditi, hi. Talk to us about your outlook in terms of what the key themes could be in this economic survey. Last year, private participation in capex was a big talking point. Are you expecting to hear anything along those lines this time too?
Definitely. I think, the hint that's been given is that the survey has been reorganized and it's longer than it used to be. So I'm assuming that lots of different topics are going to be covered in the survey. So very difficult to wager a guess, what exactly is going to find coverage, but possibly some discussion on the reforms in the agri and the non-agri sectors, maybe some discussion of PLI and other ways of spurring domestic manufacturing. What really can India do with the global environment becoming more and more uncertain with every passing month? Any future direction on trade deals, especially with the US. These are possibly some topics that we could see. The state finances report that just came out from the RBI talked a lot about demographics and transition. So maybe that also could be something that the ECO survey may discuss, because obviously India is on the cusp of a lot of demographic change. So perhaps that's something that could find a mention in this year's ECO survey as well.
Okay, we'll have in fact the finance minister speaking in just a minute or two from now, so we'll have to hold those thoughts, Aditi. But essentially, viewers, it's going to be about what is the tone and the tonality of that ECO survey that comes out. Is it going to be a more bullish tonality with regard to growth, with regard to jobs, with regard to tech, and of course then how does spends play out? Defense, capex, what changes are essentially made, and how the government also views consumption trends at this point, given all of the impetus that's been given over the last 12 months with regard to consumption, both on the income tax front as well as on the GST front. Huge sops given to that extent, 2.5 lakh crore is the total extent of that. Also, the other key piece or the key moving part is also going to be the divestment target of the government. What is it that they are forecasting with regard to divestment? Is there going to be a hint of acceleration with regard to divestment? Aditi, how does one manage all of those moving parts in your opinion?
Look, hints definitely could be there in the eco survey, but the final word will come in the budget on Sunday in terms of specifics for things like disinvestment. While there could be some cues, it's not necessarily that the budget is going to be very aligned with things like, the outlook for disinvestment, because the eco survey is going to give more of a policy framework or a medium term kind of outlook. But what the market realities are for the current year may be a little different, and the budget would probably more take a cue from what would be realistic for the current year. But yes, the eco survey will give a more overarching sort of policy focus on topics like this. Now, specifically like you mentioned, expenditure management, I think that is very important right now because we are looking at the CSS schemes having moved to a different system, a just-in-time cash release system over the last couple of years, and that has had an impact on the way that the expenditure is getting, the pace at which expect.
And we'll obviously keep you updated with regard to all that's happening in the Lok Sabha. Those were live visuals from the Lok Sabha today. We're also joined by Mr. M. Govind Rao, who is a former member of the Economic Advisory Council to the Prime Minister. Mr. Rao, a $5 trillion economy, at least the IMF expects this to happen in 2028. We'll breach that $5 trillion mark. What could possibly accelerate that, if I can ask you? What's the view with regard to how quickly the economy can grow?
Well, the most important thing is to accelerate the investment. In fact, what has happened is that the investment has been sort of stagnant at around 30-31% of GDP. And unless and until you push the investment, you are not going to accelerate the growth in the medium and long term. And to do that, you will have to reduce the cost of capital. You will have to improve the ease of doing business. You will have to sort of open up the economy for foreign direct investment to come in. So there are a number of things that we need to do if we really have to, sort of accelerate growth. More than achieving the $5 trillion, because $5 trillion is not a major issue. Because today, if you see in terms of the per capita income, we are 136 out of the 190 odd countries. So we will become the third largest economy by, sort of 2028. But that's not enough. We need to really, if we are really looking for a Viksit Bharat in 2047, substantial increase in rate of investment is necessary, and we need to, at the prevailing capital output ratio, incremental capital output ratio, we need to achieve the investment rate of somewhere about 40%. Unless and until we do that, we are going to be very difficult, and that requires a large number of, reforms in order to reduce the cost of capital, in order to improve the competitiveness of the economy, and in order to attract, global trade and investment.
Okay, lots to watch out for. Clearly, in a few minutes from now, we're going to be hearing out from the Parliament itself. But we also have Mr. Swaminathan Nayar, consulting editor at ET, now joining us on the show. Swami, sir, thanks so much for joining us. Talk to us about your pre-budget and pre-economic survey estimates. What are going to be some growth targets or some focus areas in this speech, according to you?
I do not expect this to be a budget that will be remembered. We are not in a mood, I would say, as far as the political economy is concerned, for any radical changes at this point. We are facing a very turbulent situation, and 100% I would say the world economy is going to slow down in 2026, and India will have to slow down. We may want to accelerate. You can take a long-term target and say what all is required to get to Viksit Bharat targets. But the current position is, what is the situation domestically and globally? Domestically, the situation looks beautiful. Goldilocks economy, very fast growth, 8% in the first half, and inflation so low, 2% or below. So it's a Goldilocks economy, but the external environment is extremely unfavorable. extremely unfavorable, not just a little bit. So let us see what is going to, I mean, you see the IMF forecast, you look the World Bank, everybody agrees that the world overall is going to slow down in 2026 and India is not going to be exempt from that trend. Therefore, I would say in the coming year, we need to hunker down and say there are going to be lots of storms. We don't know exactly what is going to happen in which direction. We don't know what new 25% duty Mr. Trump may give or what some concession may come from some other place. Maybe we'll be lucky at the Ukraine war ends. Maybe it gets worse. I mean, there are so many unknowns that I would say this is not a time for experimentation. This is not a time for going around thinking what radical changes can we make. In these circumstances, when the whole world economy is coming down, I mean, Mr. Govindraj just said, what about increasing investment? I mean, if I am a businessman and there are so many uncertainties and the world economy is going to slow down, is this a time when I'm going to invest more just because there is a Viksit Bharat target? No. I would say this is a time for caution, for hunkering down, watching what the storms are going to come and then move forward cautiously. We have done very well in 2025-26 to have achieved so much growth. If we can just stick to that kind of path, hopefully we will withstand the winds that we are going to see in the coming financial year. But do not see this as a year where you can expect rapid or accelerating growth. Just the other way around, I would say the global circumstances are such, we are going to slow down. So let us be cautious and careful about it and not embark on various adventures.
Okay, so those are views coming in from Swami sir. We are also joined by Radhika Rao, Senior Economist and Executive Director at DBS Bank, joining us from Singapore. Great having you, Radhika. Opening thoughts, and by the way, guests as well as viewers, the economic survey is actually out now, so we can start looking at the numbers. But Radhika, just very quickly first, your initial thoughts with regard to what to expect. Okay, Radhika, I believe you're on mute. Okay,
you're
good. Please go.
Okay.
Yes.
Yeah, okay. Sorry, so I was just saying that initial numbers, I mean, yeah, it's already flashing in your screen, which is the growth numbers, which is about 6.8 to 7.2. That is probably a shade better than where the street estimates are, but still very much doable. And I think taking on from what the other panelists are also mentioning, I think the important thing will be where is this growth coming from? And certainly I do think that the playbook has essentially changed in the last year and a half. And from that point of view, much growth will be seen coming from the domestic drivers, especially consumption and investments. And I think in the budget as well as outside of it, we will hear a lot of, I would say, encouraging narrative or commentary from the government to say that they will play their part, especially because certainly private sector might face one more year where things are not that upbeat because of what's happening globally and what's happening to the currency as well. So in that light, I think it will still be the government that will lead from the front. But certainly they want even sectors like defense, for example. There is some amount of room that they can invest in, but they will expect beyond the point that the private sector will participate as well. So in a nutshell, this is what we'll be looking for. And I think economic survey sometimes has some suggestions which are taken up by the budget, but by nature it is not prescriptive. So I think it does give a very good idea on where the CEA sees some of the main changes that needs to come about on the FDI front, on the investment front, as well as exports. And I would assume this time around there might be, I've not seen the document yet, but some chapters on FTA and global supply chains as well.
Okay, so these are some of our initial takes coming in. The Indian economy expected to grow by 6.8% to 7.2% in FY27. FY27 is likely to be a year of adjustment. Of course, this is in light of the changing mechanism of the metrics that we're going to be looking at to calculate growth going ahead. Aditi, quick take on this number, 6.8 to 7.2. What are you making of it?
So like I said earlier, we are projecting baseline real GDP growth at 6.7% for next year, and this of course is on the prevailing base. So the 6.8 to 7.2% number, which is effectively anchored around 7%, is a little bit higher than what we were projecting. And I echo, a lot of what Swami sir said earlier. This is going to be a year which is rife with uncertainty, especially on the external front. And we've had a lot of stimulus coming in from the tax relief over the last year. We've already had policy rates being lowered by 125 basis points as well. Now consumption has to respond and sustain. On the investment side, our view is that the private sector is investing, but very unevenly, and I'm not sure that it's going to necessarily broad base in the current global uncertainty. So it will be quite interesting to see now what the expenditure mix of Government of India and the state governments is. Government of India will know on Sunday. I am hoping that whatever fiscal space is there is going to get prioritized more toward capital expenditure that is going to have a higher multiplier impact and not necessarily on revenue expenditure that tends to have a lower multiplier. But for the state governments as well, with the Finance Commission report, the government already has received it a few months back, but we don't know what the recommendations are. They'll only come into the public domain along with the budget on Sunday. So after that, we'll get a better sense of what the states are going to be able to do within the new fiscal sort of constraints that they have next year. And definitely government expenditure will have to play a role in sustaining a growth of 7% or higher than that.
Mr. Rao, if I can come to you, the 6.8 to 7.2. How do you view that number? Looks ambitious or looks doable? And if it looks ambitious, what will be required from the government in terms of stimulus to achieve that?
I think 6.8 to 7.2 is on the higher side. It's an ambitious target. Of course, there's nothing wrong in having an ambitious target, but then it requires a lot more of work to be done. Partly because much of the growth in the last couple of years has been driven by domestic consumption and sort of public sector investment. Now, public sector investment has been quite high in the last couple of years, but the problem is that there are the fiscal constraints. I mean, if you are going to contain your debt to GDP ratio to 50% in 2030, then obviously you will not have so much of a leeway to sort of spend more and more on capital expenditure. And even at the state level, I think the fiscal situation has substantially deteriorated in the last few years, because the prioritization has been on basically social welfare expenditures. Now, as a result, what has happened is even spending on education and healthcare has not been has been going down. So in that particular situation, increasing capital expenditures is not going to be it's not going to be a major sort of item in the agenda for the states. Now, in a situation like that, I don't know sort of major drivers. Of course, there are issues like what will happen to weather and various other things, but then 6.5% is a normal growth we can expect, but then 6.8 to 7.2, I think is a bit of an ambitious target.
Okay, so an ambitious target. It's all eyes are going to be on whether at the end of this fiscal year we're able to achieve this band of growth or not. But Radhika, talk to us about this one line that really stands out to me from the economic survey, and it talks to it says in terms of bearing systemic shock and seeing the transfer of financial stress, India needs to run a marathon and a sprint at the same time. What are you making of this line?
Hi, I think this could be referring to, generally the volatile financial markets outside of India. We have seen quite sharp moves in the dollar. We have seen very sharp moves in the precious metals universe. There's a lot of talk about debasement, de-dollarization, and the impact on India has been very varied in the sense that, even though the dollar has corrected a lot. Rupee has been under pressure. In fact, today as well, rupee has weakened to a record low. So I think I would say this, and the takeaway for me is that to keep the external vulnerabilities low and sufficient buffers in place, because this is in the long run. Some of this could be momentum based, some of this could be one-off factors. But I think when you look back at the economy and look at does it have enough cushion, that is always very important. And I think at this point, I do think what's happening on the currency front, for example, to some extent, it's very, very flows driven. Current account is in decent health. We have seen reserves actually been partly because of valuation effects, but stay strong. External debt is within control. So in those terms, I would say the buffers are sufficient. But sometimes, again, because of flows, some part of the flows are outside India's control, in the sense that there are some thematics that are playing out. There is some regional, I would say, regional drivers that are, attracting more flows. So from that point of view, my takeaway from this sentence would be that we have to keep an eye always on the macro stability indicators. Keep them, sufficient. We don't have any risk, any of the vulnerability indicators getting weakened. And I think from that point of view, I would be actually looking for comments, if any, on the currency as well. What does the economic survey make of it? Do they see that as a structural issue, or do they see that as a support to exports down the line? My take is that, just a currency depreciation alone, that kind of a competitive advantage is difficult. Is difficult in an environment when at least some of the key imports or key exports that India does also has high import dependency, to mean that that pass through of costs will come in first before these can be exported out. So I don't think the currency alone can be used fully as a competitive advantage. It can be kept at competitive levels, but sometimes this can turn into a vicious cycle as well. So this is what I would think these comments are referring to.
Okay, panelists, we're going to have to take a pause here. Swami sir, good to have you back. I'm very tempted to ask you a question, but I'm going to have to take a mandatory break. Let me do that. Let me go dip into that commercial, come back and ask you with regard to your thoughts with regard to that growth number that we're penciling in and what India will need to do to achieve that. Stay tuned, viewers. Welcome back, and we have with us all of our guests speaking about the economic survey. Swami sir, let me come to you. The 6.8 to 7.2% kind of GDP growth that we're targeting, give us a sense of what it will require. Will it require a larger focus on capex, which has been heavy over the last few years? Will it be a larger focus on consumption? Will it be a balance of both? What will it require? Will it require employment impetus? What will it require?
Let me be clear that I am not among those who think that the budget is such a huge weapon that by tweaking this and tweaking that, I can change the rate of growth and I can decide which sector is going to boom and which is not. I do not believe the budget is a strong enough instrument to do all that. If we have arrived at a situation in the current year, we are at this Goldilocks economy, this wonderful situation we are at of 8% growth and less than 2% inflation. It was not brought about by some little fiddle in the budget. This is a consequence of reforms at various different levels, moving forward, strengthening the economy and increasing productivity. And that is the kind of thing that I think we will have to be looking at going ahead. Let me say this, as Govind Rao said, it's an ambitious target. When you look at all the possible problems going on in the rest of the world, when you see the IMF, World Bank saying, the whole World Bank, everything is going to slow down. And India is a country where the total of imports and exports is like 40% of GDP. I mean, we are dependent on the rest of the world to a significant extent. We are not insulated from what's going out. So, and things are going to slow down. But I will simply say this, we have consistently been exceeding expectations quarter after quarter after quarter. So there is something fundamental of all the reforms that have been taking place in the last 10, 15 years. And that, I think, has strengthened our sinews so that even in difficult conditions, we have been doing better. Given that, I would say yes, I think that 6% 6.8 to 7.2 will be reached unless there are some really difficult things. That at the macro level, when the fiscal deficit keeps coming down, that is not a stimulus. It is consolidation, in some sense anti-stimulus. So we should be right now consolidating. We should not be trying various things. What about a huge additional subsidy for that sector? What about extending PLI to another 5 sectors? I do not think we should be going in those kind of directions. So I would simply say that we have been doing a pretty good job. You know, the committee last year, Nirmala Sitharaman said that I'm setting up this committee, commission to look into deregulation, getting rid of various things. A committee has been set up. From all the reports, it has done very good work. From all the reports we are getting, you know, a very large number of regulations sector by sector have gone. But even then, you had the steam lease report showing that for a stand-alone solar park, you needed 2,735 compliances per year. And you have to ask, you know, what is this bewildering amount of red tape? So cut. To my mind, that is the kind of important thing. I'm very glad Nirmala Sitharaman did this in the last budget. I do hope that she gives us a sense of how we can go further in this particular area. Beyond that, I would say, please don't be adventurous in trying to open new areas for PLI or increasing PLI subsidies too much. Whatever is happening right now is already enough, if you ask me, to have got 8% growth in the first half. It is such a good performance that let us not just pretend that by giving more subsidies, you can accelerate anything significantly.
Okay, shifting focus from that, so the key takeaway here from Swami sir is don't be adventurous. The current measures in place are enough to achieve this kind of growth. But shifting focus, Mr. Rao talked to us about rupee and currency. Very interestingly, I was reading the first 16 pages of the economic survey, that is the letter from the CEA, and the word rupee is mentioned 6 times in
Currency
this entire
stability.
currency stability too is a big talking
mentioned.
point.
At least 5 to 6 times.
Absolutely, and the document also says that the rupee is currently punching below its weight. Are you expecting to see any currency appreciation anytime soon? Mr. Rao, that question is for you.
Yeah, well, I mean, I don't expect any currency appreciation to happen because, we are already okay with the current account deficit, all right. But the problem is there is a lot of both foreign institutional investment. There has been outflow of a lot of foreign institutional investment that's happening. And I am not going to cry much because if rupee is depreciating. Well, it could, sort of, in some ways, it has to find its right place. Appreciation is something which I do not expect it to happen, at least in the short and medium term, because the conditions are such that even the foreign direct investment is not really net in terms of the net foreign direct investment. We are not getting much, and foreign institutional investments are going away. So in that situation, there will be continuous pressure, and I don't think the Reserve Bank should try to lift up the exchange rate.
Okay, so that's a thought coming in with regard to the currency, but there's plenty of other movers as well. There is a very, very fast evolving geopolitical environment, and there's gold and silver. We'll quiz Radhika with regard to that on the other side of this very short break.
welcome back to this very special coverage of the Economic Survey 2026. Let's continue dissecting this survey and what our experts are making of it. Radhika, coming to you now, I'm going to read you a few words from the CEA's address that really stand out, wherein he's saying growth is good, outlook is favorable, inflation is contained, and more importantly, external liabilities are low. We've been talking about the ever changing geopolitical situation and the scenario worldwide. Talk to us about how much of a dent, if at all, that could create to our economic projection, because the outlook from the survey, what we're getting right now, is quite optimistic.
Yes, certainly. I think it goes back to what we had discussed earlier, which is that there are two main engines that essentially growth is coming from for most of the EM economies. That would be the external sector and the domestic sector. Now, traditionally, domestic sectors have certainly domestic drivers have been very important for India's play. And I think what we have seen in the past year and a half is that what used to be a completely supply-driven push, more infrastructure, manufacturing sector support, providing more, taking these steps towards better governance. Add to that has been a push towards also putting more money in the hands of people, tax rationalization. Now, we should remember that this does come with a literal cost, right? In fact, the gross tax revenue growth has been slowing down for the past 3-4 years. And part of that has also been because of these tax rationalization measures. But nonetheless, there is a shift within how the government is also responding to it. Started off with supply, and now it's supply and demand, where they're taking action. And I think going back to your question, certainly so that is where the mix will be when we look at the 6.8, 7.2% number as well. And add to this, interestingly, the potential growth also seems to be, according to the report, closer to 7% at this point. This was, if I remember correctly, it pegged at about 6.5% 3-4 years back. So the survey also seems to suggest that despite what's happening globally, domestically there is enough, I would say, momentum to take growth even higher. So one of the things that will might not be at least in the calculation technical basis is inflation. Now, one of very low deflators were very important reason why normal real GDP growth looked very good in fiscal 26. That will kind of fade off going into fiscal 27, which essentially means that GDP deflators will become larger, probably in the 3.5-4%, where then naturally it brings down the growth level. Now, all this said, a lot of discussion on these numbers. End of February, we might be dealing with probably a different set of numbers because the revised numbers will be available. And when those are in, we might see some sectors that have fared better than what these numbers seem to suggest. So net, I would still maintain that there is a change in the playbook, and that playbook is more domestic growth oriented. It's always been an important driver, but I think strengthening it now it's been given a lot more importance. Just like the other panelists mentioned, the budget might not carry any big bazooka reforms, but I think of late we have also seen that a lot of announcements are happening outside the budget as well. So from that point of view, I think it will lay the ground, about where the ambitious goals are and what small tweaks can be done towards it. But a lot more action beyond the budget could also happen to get us there. But I think I hope that the assumption overall in the math is that external trade does contribute, but does not contribute in a very big way. Because even the FTA that has been signed, all of that would only kick in 1 year from now. So we will see material benefits, if any, thereafter.
Aditi, would you reckon that India has dealt with the global geopolitical challenge over the last year with reasonable gusto? Would you say that? And what do you make of the moves with regard to gold and silver, and the entire likely reason for that is de-dollarization? You expect that trend to sustain?
The last year, of course, has been extremely challenging on the external front, and I don't know if we're going to be in for less of uncertainty as far as the external situation is concerned in FY27. So base case, I think we have to assume that some amount of uncertainty will continue. And while, of course, everybody, especially exporters, have been waiting for some trade deal to materialize with the US, we really don't know when it will come through. And I think there is some level of fatigue which is coming in, that even if a trade deal does get materialized and get signed, who knows when some policy irks the US, and again some new tariffs get announced or some other penalties get imposed. So I think there is some amount of fatigue as well which is setting in. And this is something that will have implications for the confidence level, especially of exporters, and it will have implications for the kind of domestic investment scenario that we can expect over the next year as well. So I think this is just something to keep in mind, that while overall with the amount of stimulus that we've had from the tax side and from the monetary side, definitely domestic consumption is sitting in a very good place. We've had a good monsoon last year. The reservoir levels are very full. It takes away some of the edginess in terms of what the next monsoon will bring for the rural sector as well. So there are a lot of positives which are in place on the domestic side, and certainly that is expected to be the main driver of growth in the year ahead. But I am still pretty cautious in terms of what the external sector could bring. We've seen in FY26 an 8% growth in the first half of the year, which did benefit quite a lot from this upfronting of shipments to the US. So again, whatever positive there had to be in to be taken away from the current situation, possibly that's already in the numbers, and the pain lies ahead unless that trade deal materializes very soon. And whenever it does, that the US then also sticks to it and doesn't impose any further penalties going ahead. So I would still be pretty cautious for the year ahead, despite the fact that domestic macros certainly do look much better going into this year than maybe they have in a long time.
Okay, so with that, we'll wrap down this edition of our special coverage of the economic survey. All our panelists, Mr. Rao, Radhika, Aditi, and of course, Swami sir, thank you so much for weighing in on your reading of this survey. With that, we'll wind down this very special edition. Thanks so much for tuning in.